Morning, guys. Good to see you. Mona, let me start with you. Obviously, Target is arguing the consumer does have money to spend, but are we beginning to see some of the cracks that the Fed is clearly hoping to introduce without too much pain?
Yeah, I think it was interesting. I think Target's report this morning highlighted what the trends we've been actually seeing on an ongoing basis, which as the consumer started this year in a healthy position, excess savings still nearly $2.5 trillion above pre-pandemic levels, labor market healthy, healthy balance sheets and healthy spending trends. Where the pressure has been really coming from has been the supply side of the equation. So when we think about inflation broadly as a supply-demand dynamic, really the Fed is trying to impact the demand side of the equation. The supply side is a little less known, harder to handicap, depending on what happens with some of these supply chain pressures, really with some of the labor supply as well. But even the Target CEO this morning alluded to the fact that hopefully by the second half of the year, we see a clearing in some of these. And so, in our view, we do think from a market perspective, this market is really looking for not just one sign of lower headline inflation, but 2, 3, 4 lower prints in inflation to get a trend. And once we see that, that's really where we think we can get a more meaningful rebound in market, perhaps even a Fed that thinks about going at a more gradual pace. But until then, it seems like markets may be range-bound, constantly going back and forth between the demand equation and the supply equation. But really what we need to see in this market is a better inflation dynamic.
Right. That certainly describes the recent period. And, Jeff, I do wonder, clear and convincing, those words were clearly said for a reason. What do you think it represents? What is clear and convincing? How many prints is it? And how does it need to be framed by the Fed?
I think it may even be how quickly it happens. Look, what we heard from Target isn't just in a vacuum. I've been talking about this shift from shortages to gluts, which happens so fast it can surprise everyone. We're hearing it from Target, but GM CEO Mary Barra was talking about semiconductor supplies being normalized by the third quarter. We're hearing this shift from tight supplies to abundant supplies and perhaps excess inventories. Inventory levels are above average for most businesses right now. Work in process inventories, not finished. It doesn't take long to go from work in progress to finished inventories and products hitting store shelves, cars, game consoles, phones. So I think this could turn around fairly quickly. So it might not be that we need to see 4 or 5 or 6 in a row, but just some dramatic moves to the downside in some of these pricing pressures, at least on the pipeline side. That could be enough to cause the Fed to begin to pause. I'm not necessarily predicting that, but I think looking at to September or beyond and expecting further 50 basis point rate hikes in this environment of a rapid shift from shortages to gluts is probably expecting too much.
So, Jeff, then, if there is an inventory glut that you see out there, do you think that, just to kind of follow up on your earlier commentary and what Mona was saying about, the supply and demand dynamics and what the Fed can and cannot control, do you think there's an argument to be made that the Fed should just take a pause now and that things could come down on their own and we may not risk, a potential recession as a result?
Perhaps not yet. We know that supply chains are vulnerable to any kind of shock, and we're China to head back into another series of lockdowns. We know they're beginning to emerge now in Shanghai and other places, but that could exacerbate the problem. Another Ever Given stuck in the Suez Canal could exacerbate problems. We don't have a robust backup system right now, so any little shock to the global supply chain could cause these problems to worsen. That's why the Fed should remain on its current path. But as we look out to later this year, those inflation pressures may be easing more rapidly than many expect.
Shepard Smith here. Thanks for watching CNBC on YouTube.